Welcome to Future Focus, a financial strategy podcast where we make the complex simple. My name is Troy Branch, and I'm here for part two of our conversation about OB3, the big beautiful bill. We like to call it OB3 because, again, we're unapologetic Star Wars nerds. I'm joined here again with Keali Joe.
Hi.
And Jacob.
Hey, Troy, that listener last episode was fun, wasn't it?
Well, it was a lot of fun. And like we talked about, we're going to end up doing that. We're going to try to do that every fifth episode. I think it'll be a lot of fun. I know when we've had people and we've asked people for input, it's been fun to see the questions and go, okay, that's maybe a 2 question, or we can do 5 of these. So it's fun.
Yeah.
I can't wait.
Let's keep those questions coming.
Throw them in the comments. We do read them.
Yeah, absolutely. And like we're excited when we hear when we get a question in the comment that we can take and say and decide where we're going to fit it into our listener episode. So
hey, we can spend 5 minutes talking on this. Maybe we can spend a half hour talking or 20 minutes talking on it.
Yeah, we don't want to go half hour.
That's why I change it down. It's 20 minutes.
Like throttle it back. We're aiming for 20.
Complex must be simple.
Yep. Right, exactly.
Be short.
Okay, so we're going to pick back up where we left off on myth or reality about OB3. Everybody good? We ready to go?
Yeah.
SWN. For
those of you, if you remember, we talked about more of the personal implications regarding OB3 in the first part of this conversation. So today we're going to talk about more of the estate planning, and we'll hit a little bit on business. I have a sense if you look back, if you go back to episode. What would that be? I think it's
15?
episode 14. 14, yeah. I think it was. If you go back to episode 14 and you want to see the first part of this conversation, by all means, check out 14 and 15. Actually, you can go from 1 to 15 if you really want to binge it and just get crazy. But in episode 14, we talked a little bit about the 1202, and we'll get into that a little bit more just so people understand sort of what that is and why we were excited to talk about it, because it has more business owner implications. It touches, frankly, we can make it touch estate planning as well. Mm-hmm. So we're going to do more business owner, more estate planning implications of OB3 versus the personal implications that we talked about in episode 14. All right?
Let's do it.
Same format. Myth or reality? Give us your answer. Tell us either myth or reality, and then we will dive in. Okay. Sound good? All right. So make sure I get it to the right spot. Okay. So first one, myth or reality? Estate taxes won't affect you until 2026.
You want to go first? Or you want me to go first?
Estate taxes won't affect you until 2026. Well, it depends on where you live.
By the way,
are we talking federal?
As you say it out loud, that's a terrible question I wrote.
Okay. Let's put it this way. Is there an estate tax, federal-wise? Yes or no? Yes, there is an estate tax. That is a reality.
I
guess I didn't answer his question.
Let's
say Repeat the question again.
Troy really likes
saying, is it a myth or reality? Just myth or reality. Is it a myth or a reality? Estate taxes won't affect you until 2026.
Myth.
Okay. What do you got?
Really want this just to be a one-word answer, but I can't do it. I don't see the word all or never or none.
It's not a legal question.
So there's no of those extra words. So
estate taxes won't affect you until 2026. Myth or reality?
Myth.
Okay. All right. Now
it's just not as fun.
Go ahead and expound.
So, of course, everybody forgets there are state estate taxes. That's not what we're talking about here.
No.
We're talking about federal estate taxes. And technically, this won't affect most of the population. The exemption, which means that you just don't have to pay tax on it up to this amount, is 15.
We'll say gift or estate tax.
Gift or estate tax is $15 million.
He just corrected the JD.
Well, no, he just added in there.
Just made
there
JD.
Was no correction.
He made you more precise.
Okay. The unified gift and estate tax exemption, if we want to be specific. No. You brought that in there. You baited me into that one.
Jargon jar. Go ahead and get it in.
I refuse. I protest. So right now next year there is a $15 million exemption, which means if you have an estate of $15 million or under, you're not paying tax. So it won't apply to you.
That's fun. I feel like I'm gonna put some bullseyes on me, but I feel like to help clarify that, so that 15 million, that's for single individuals. So
well, there's no such thing as dying married.
So for a married couple,
Unless
so for married individuals, that's 30 million.
Well, not necessarily.
Nope.
Am I going to get dinged for this if I use the
yeah,
right word?
Go ahead.
I don't want to be dinged for this.
Go ahead.
Okay, it's called portability.
Yep, there you go.
Okay, portability. You don't die married filing jointly, you die alone. Unfortunately, that's what it is. So when one
Kind of a line out of
spouse
person of interest, isn't it? Anyway,
when one spouse passes away, any portion of that unused exemption they can give or port over to the surviving spouse. Hence portability. We're porting it over. So the surviving
Can I ask you a
spouse
question? What do they do to port it over?
file form 706, but that's not fair. No. You can just you can fight me on this
I
one.
can get her to say it.
Anyway, portability. If you pass away with unused exemption, you can give it to your spouse. So if they died with $15 million unused, the spouse can technically claim 30 later on.
So let me.
And how do they technically claim it? No, I'm just messing with you. Go ahead.
So let me.
You wanna fight today?
Let me rephrase, counselor. Between a married couple, they have the 30 million for 2026 available
If they don't use it before they die.
if they don't use it between the two of them at some point, living or at death.
If they don't use it.
Teeth, man.
Yes.
And of course, and why this is important is, for 2025, it was 13.99 per individual. We had a lot of conversations. I mean, we had episodes where we talked about the sunset that was set to occur at the end of this year, which was going to bring it back down to about 6 to 7 million index for inflation per individual. So with the one big beautiful bill.
Excuse me, what was that again?
Sunset?
You said, no. What was the thing that you said?
I don't even know what you're talking about.
Like, you said it
Individual?
It went back to what?
13 what?
7 million?
It went back to, and what was that? What was that thing?
What did I say?
You know what you said.
I don't know what you said.
You said index for inflation.
Oh, yeah, you did say index.
So what is that?
I mean, I see all my little pebbles. We're getting so used to being outside the jar.
Yeah,
I guess
well,
we can throw one in. All that means it's going to grow at some rate. It's going to increase at some rate. Typically, it's an inflation type of an increase.
The cost of living adjustment.
If it would have gone back to, here, I'll help you out. If it would have gone back to whatever the amount when the Tax Cuts and Jobs Act,
5 million.
it would have gone back to 5 million, and then they would have inflated it according to the inflation numbers or the cost of living numbers from 2018 until what would have been 2025.
Yeah.
And then it would have settled in at a number likely around $7 million.
So what's nice is because the first part of the episode we did here, we were talking about a lot of the provisions that impacted the middle class or middle income families. This is a provision that really is more of an impact for those high net worth individuals. So because it's 15 million an individual starting 2026, it's less of a conversation for a wider range of the population, and it's more focused on those high net worth individuals. But now I would say there's some certainty now. At least it's permanent until it's not, but at least from a planning perspective, you're not worried about.
We're not having the fire sale that is hey, the sunset's coming.
It's coming at the
Yeah, the estate tax exemption has changed so many times. I mean, at one point we eradicated it completely, and I think that lasted
Actually,
less than a year.
It 5 times.
Yeah, it's gone away 5 times. It's come back, what, 8?
6.
6?
Well, it can only come back 6.
Oh, yeah, you're right. My math is horrible. 6. I'm done. We changed it like 8 times in the past 8 years. Excuse me. I was dumb. That was a dumb comment. You're correct. Math is hard.
Math is math, Troy.
I have 2 accounting degrees.
Math is undefeated. Math is undefeated.
Math is undefeated, yes. But they've changed it like 8 times in the past 9 years. Yeah. Something crazy.
So
like
what we
that.
know is it can change, but at least we know there's no plans for it to change anytime soon. So at least there's some we'll call it a little bit more stability when you're starting to do some estate planning concerns and planning for what you want your goals to be.
Yep.
At least you at least know what those numbers are set to be, at least for a little while.
Yeah, there's no ticking time bomb. It's not going to go away.
All right. So on to question number 2 for today. And you guys have maybe talked about this a little bit, so we'll see kind of what we get out of this one. All right. Lifetime exemption changes don't matter until I die.
Myth.
I mean, technically, that's a reality, but because you don't care until you're dead.
Do you though?
I mean, you should care when you're alive.
No,
Most
no,
people
no,
don't.
no, no.
Okay, myth.
No. You said reality, so
No, I'm just thinking it through out loud.
okay.
Myth.
Myth. Okay. So why the trepidation between myth and reality then?
Just because, like, technically nobody cares about what the exemption is until you
I should
die,
throw one in
unless
for
you're.
using the word trepidation. Sorry.
Yeah, how dare you? But yeah, I mean, you should care about it while you're alive because you can actually do something about it if you want to maximize what you give your beneficiaries.
Well, that's just it. If you plan for it now, you're not caught with surprises later on or when it's too late. It's like, for example, let's say you own something that is appreciating quickly. Maybe, it's real estate. Maybe it's, some, your qualified account, in retirement, assets, whatever it may be. If something is growing at a pretty rapidly rate, maybe it makes sense to put some plans in place now to plan for what that's going to grow to
remove some of the gain. You're talking about taking a proactive look at where I'm going to end up.
There you go.
A failure to plan is a plan to fail.
And I was going to say where I thought you were going was, because the question is phrased, lifetime exemption changes don't matter until you die. And I was thinking it was something that you mentioned earlier, or actually Jacob mentioned in his correction or being more precise.
I'm glad I brought something of value to this episode.
Absolutely. It's a lifetime gift
And
estate.
Can I talk about that?
Well,
So
you just got
I'm
to
going to do it
get
anyway.
I'm going to get out of your way.
I love estate planning. It's my thing. So what does it mean to be a lifetime gift and estate tax? So you have an exemption for gifts that you make. This year you can give up to $19,000 just individually, or double that if you're married, to any individual per year. So if I want to give you
individual,
if I can give you $19,000, I can give you $19,000.
Sounds good.
I would never do that. Anyway, I could do that tax free. But let's say I want to give more than $19,000.
What type of tax free?
Give tax free.
Okay.
Yep.
Let's say I want to give you more than $19,000. Maybe I like you. I might want to give you 50, right?
Sign me up.
But I don't want to pay taxes on it. So what can I do? Well, I can pretty
What kind
much
of taxes.
gift taxes.
Well, there's gift tax, there's income tax.
Okay.
It's important. It's an important distinction, especially when we're talking about the unified gift and
our
estate
listeners
tax.
are intelligent. They're
It's
following.
all about the details.
Okay. But then you penalize me when I give details.
No, only when you give complicated details.
That they're all complicated. They're details.
But our job is to make the complex simple.
I'm doing my best. So let's say I want to give you more than that, but I don't want to pay taxes on it. You can essentially rob Peter to pay Paul, where you're taking away from your estate tax exemption, which reduces your estate taxes, and
was
use
emphatic.
it. For
I think that was
your
aimed
gift
towards you.
tax.
No,
I was
your
looking
way.
right at you. And you can pretty much reduce that instead. So, like, if you're not going to touch your $15 million exemption, because, I mean, I hope I could, but I can't right now, I'll just reduce that. And then I won't have to pay gift taxes today.
So, like you said, how did you say it? It's the planning now, the proactive planning.
Proactive planning. So you're looking forward to where you might and to where you're likely to end up,
or could
end up.
And I think part of it, because that's part of a big conversation for people. What are their estate planning goals? Do they value giving gifts now while they're living, and maybe it's using some of their annual gift tax exclusions now and part of their lifetime exemption now, or are they more concerned with giving gifts at their passing? Mm-hmm. So it's just part of those conversations that they should be having with a financial professional.
This is a callback to our for us it was a top 5 list when we talked about the top 10 uses for life insurance and modest estates, and we took quite a bit of time to define what a modest estate was, and it was specifically around states that are likely not going to be impacted by the federal gift and estate tax the federal gift and estate tax exemption number that was now been increased to 15 million by OB3. So to bring all of the episodes full circle, see, like we just love to teach here.
Yeah, I mean, hey,
I never want to stop learning.
Yeah.
you may not have 15 million now, but depending on your age, depending on how fast your assets are growing,
You may run into
could.
it.
you may run into that
The
concern.
law could change.
And the law could change. I mean, there's a lot of things, but from a growth standpoint, one of the things that we do quite a bit is when it's time to is to examine where someone might end up. And no, I don't have a problem now, especially with larger exemptions, but I may have a problem. If we start, if we look at it logically and where you might end up.
Yeah.
And again, it's probably a good time to go. We're not trying to give a specific recommendation. This is just informational and educational, and sort of a inside look into the conversations that we have, and it's not intended to be advice. Okay, so let's talk pass-throughs. I'm going to go ahead and spare everyone a pebble in the jargon jar when I ask this question. Pass-through deductions are untouched.
Reality?
Yeah. Oh.
I mean, I guess not completely untouched, but pretty much untouched, yeah.
All right, reality.
Qualified reality.
So do you want me to define pass-throughs?
You know what? For these last two questions, since I know you guys talk a little bit more from a business structure standpoint, I might just have to play the questionnaire, and I'll kind of sit over here and listen to the both of you talk and
Tapping out
and pose the questions to you guys.
All right.
So Troy, you don't get to answer questions as much. You're usually replying to our comments. So yeah, we'll have you go. We'll have you provide some commentary on this next question.
Pass-throughs are untouched. So I'm going to go ahead and say, because of the logic games, right? Like it's when you say are untouched, that's sort of the definitive. And the fact is they're touched just a little bit.
if we're being definitive, yeah.
Yeah, they're being
changing my
touched just a
answer.
little bit. So it's not. So,
You want to be definitive.
exactly. So it's a myth.
Yes.
Because they are touched a little bit.
A very little bit.
So if I was Troy at this time and I just got the myth or reality answer.
First of all, you need to change your haircut.
my my next question for you both would be like, so tell me more, or tell me why.
So first, let's define what a pass-through is.
That's what I was going to do.
So a pass-through entity is a entity that literally takes the taxes due and passes them through to the owner. So the owner individually pays the tax that's earned by the entity.
So I'm going to play Jacob in this one. So let me let me translate that for you.
Partnership. It's a partnership. That's what it is.
Think limited liability companies, also known as LLCs, because I don't want to put
If
anything in.
it's taxed as a pass-through, it might not be.
And then
Details.
So think LLCs taxed as a partnership, tax as an S corp.
Tax is a partnership.
I said tax as a
Oh, I
partnership.
thought you meant S corps.
Yeah. No. I'm saying an LLC can be taxed as a
Yes.
partnership, can be
Or
taxed
as
as an
S-corp.
LLC or taxed as an S corp.
Yep.
Actual S corps. Am I missing anything else?
Partnerships.
And actual partnerships that you hardly ever see anymore.
Yeah.
Because usually they have some. There's usually something. So those are what you should be thinking when you hear the word pass-throughs. It's the way I think about it is the business is the business is the taxpayer, and the taxpayer is the business for tax purposes. Meaning there isn't a separate tax bracket for the business and the taxpayer. They're one and the same.
You are the same.
It passes through.
So specifically, I'm assuming this question is asking, and I'm not paying for this because this is what it is called, Section 199A, which stands for Qualified Business Income. Essentially, it is a deduction. It's like 20% that you can reduce your taxable income by. So if I
Just so that is phased in, or that phases out over a certain level of income.
Yep. So if you make too much,
Pardon
we
me for
don't
not
give
knowing
you
that number off the top
that
of my head.
deduction. Yeah, that's okay. So that part Tax Cuts and Jobs Act, before it was going to have that section actually sunset and not really be a thing anymore. So what OB3 did is it made it permanent, and it just barely touched it, and it said, okay, we're going to provide a minimum deduction. If your income is $1,000, we'll give you a freebie of $400. So that's changing that 20% to a 40%, but only if you make $1,000. So it's really minor. It's like a weird thing. I don't know why they put that in there, to be honest.
So untouched?
But yeah.
No.
No, it was touched, but very lightly.
Very, very, very. It was a gentle, brush of the hair. Anyway,
It was with love.
I like hair jokes. I'm sorry. I mean, I'm bald. So,
Oh, and I
anyway.
guess they increased the phase out rate too, so you can make a little bit more money now.
So
and
now,
still get the deduction.
you can have more income.
Yeah.
And not be phased all the way out.
Yep. So
All right.
Okay.
Now, hold on.
No. Jacob's playing host to
Okay,
these
my
final
bad.
two questions. So, anything additional to add on this? I got to use my hands like Troy. So, anything additional to add?
you say you talk with your hands. You gonna
I,
take that?
I clearly talk with my hands.
Before we move to the final question.
That's the worst kept secret. And Keali Joe, you got excited about this section, and if you are a business owner, like if you have a basis in your business and you're thinking, hey, I might want to sell my business in the next 5 to 7 years. Or you just figured out what I was going to talk about?
Yes, can I talk about it?
Yeah, I am.
Set it up.
I'm
Set it up.
getting there.
Bring it this
Calm down. All right. So if you're a business owner and you are thinking that I'm going to have if I'm going to sell my business, if you're thinking I'm going to sell my business, I don't know, 7 years from now, and that's something that's of interest to you, then Section 1202. Section 1202 is going to be really, really important to you, or at least maybe you don't, maybe you're not going to end up using 1202, but you're going to have a conversation about it. So go ahead and tell us what 1202 is.
So let's talk about 1202. What is 1202? 1202 is a qualified small business stock. What is a qualified small business? A qualified small business is a C corporation that has assets of less than $75 million, which I don't know about you, that's not very small to me, but small, I guess.
It's small in that world. It's
From
small.
a
enough.
business standpoint.
Pretty much.
Yeah, we're not again. We're not. I'm using the word erudite. We're not so erudite again. It's kind of like trepidation.
Okay. It has to be participating in a qualified trader business, which essentially just means like no services, no farms, no banks, all that fun stuff. You have to like make something. That's an oversimplification. Make sure you talk to your tax attorney. But I like to think of it as you actually
We're
have
not
to
giving advice.
think about, like you actually have to make something. So let's say you qualify for all that. What does 1202 do for you? If you hold the stock for either 3 years, 4 years, or 5 years, you're entitled to pretty much not be taxed on the gain from the sale of that stock. And that's a big deal because the amount is either $15 million or 10 times your aggregate basis. And what do I mean by aggregate basis? Essentially, if I am an angel investor,
And it's whichever one is greater.
whichever is greater, which is huge. If I'm an angel investor, I find a C Corp and I think it's going to go gangbusters. I invest $10 million and I was right, it does. And it's worth, I sell it for like $100 million. I can exclude 100% of that gain. That's insane. That is a huge deduction for ultra high net worth and people who own C corporations.
Yeah, well, couple of caveats. It has to be a C corporation.
It has to be a C corporation.
So when we think about why are we talking about this with pass-throughs? Because if you go back to my example where it's pass-throughs that you may be thinking about selling, you're gonna think or you should be thinking. You're likely to think long and hard
I wonder if I should change the structure of my business.
Exactly.
And it may be a perfect time to talk to someone about that.
And now I can have, because it used to be a 5-year holding period that you have to have, but now with OB3, it's a 3-year holding period, which
For
means
50%.
I get 50% of the whatever that deduction number would be, or whatever that lack of inclusion number would be. At 4 years is 75%, and then back to 5 years. If I've been in that structure and I've held for 5 years, I can have the 100% exclusion like Keali Joe just described.
I do want to qualify this, by the way. With C corporation stock, well, yes, it has to be a C corp. That doesn't mean any C corp that is in this trader business. You have to get the stock directly from the company.
Yeah.
So you can't just buy it on the stock exchange. The company has to directly issue this to you.
Well, likely at these numbers, you're not dealing with a company that's on an exchange.
Yeah.
So from that perspective, when we talk about small business, and the reason why they call it small business, even though 75 million is a big number,
It's huge.
right? But it's not but in the world of big business, 75 million is not a big business.
I just don't want people thinking, oh, I can go buy C corp stock on the stock exchange. Woo!
Absolutely. True.
I think the big thing, as what you guys were both talking about here with this one and what we talked about is state tax in the beginning, doing some planning ahead of time really beats waiting to do planning when it's almost too late.
Thinking about selling my business and, I really want to get out and I'm 6 months away. Man, it'd really have been nice to be a little more forward thinking, in this case, backward thinking and going, because I've sat down with someone and I've thought about it. And in reality, I want to be out in 5 to 7 years. Having that conversation then
Is invaluable.
It's those proactive thinking, the forward thinking, having those conversations and thinking, what are my concerns? What are my goals? What do I want to do?
Right.
And then putting some actions in place ahead of time.
Absolutely.
All right. So, Jacob playing host for the final question here to ask the both of you. So as a host of Jacob and the JDs.
No.
Yes, we'll have to pull the production crew. I see a lot of thumbs up saying
he's lying to you.
Fire White Snake.
They like.
He's the face. He's the pretty face.
Jacob and the JDs. All right. Final question of the day for the two of you. Bonus depreciation is gone.
False. Myth.
Yeah, myth.
It was myth or reality. False was not an option.
False.
It's a myth. And bonus depreciation was something that came about as part of the Tax Cuts and Jobs Act, and it was one of those things. Now, hold on. No, it was set to expire.
You better explain what depreciation is.
Oh no. First of all, I'm not going to explain what depreciation is for someone who's just a test away from. Is it one test or 3 tests? One test away from being a CPA. Again, that does not mean she's giving advice. So you go ahead and explain what depreciation.
I'm just asking the question. So,
and I'm going to preface this with I refuse to pay. Okay. All right. Depreciation. So when a company buys an asset, like an actual tangible thing, they can either expense it right away, and that would reduce like your taxes due, right? That's what it is. Or they can what we call capitalize it, which means they just put it on their books and they'll expense it later. Okay. So with the bonus depreciation, when we do depreciate property, when we're actually expensing it, depreciation is the act of expensing it. We're doing it in chunks at a time, and you're only allowed to expense a certain chunk of that. But what the bonus depreciation does...
Can I give you a for instance?
Go for it.
For instance, when you have a piece of real property, like an actual building, I think it's residential, you can depreciate you can depreciate over 27 and a half years.
Yep. So that means every year for 27 and a half years, you can reduce your taxable income by the depreciation amount.
That was a good job playing Jacob with the example of the situation.
There you go. See?
Yeah.
See?
So
it's fun playing the simple rule.
You just called your rule simple.
No, I called my rule simple, and you're playing my rule. So I say Jacob has the making things simple.
But so what is bonus depreciation? It just means that the tax law allows you to pretty much expense the entire thing in day one. Mm-hmm. Let's say I buy a tractor for my farm. I have like $100,000 of income. Let's say I buy this tractor for $50K, and I know very much that you cannot buy a tractor for $50K. They are very expensive. But instead of me expensing it over, let's say 5 years, where I take $10,000 a year, I can just take the full $50,000 this year, and then that makes my $100,000 income only $50,000. Mm-hmm. So it is a big benefit because it just increases the amount of money the company has left over after taxes, which they can use to reinvest in themselves.
Right. Absolutely.
So bonus depreciation under the Tax Cuts and Jobs Act, I believe it was going to expire.
Correct.
So what did OB3 do? Didn't change it. They just made it permanent.
So yeah.
Which it makes it more of a benefit.
Yep.
Right.
So
They just brought it back.
So you want to take us out of here, or you
No.
or you done being me?
I'm done being Troy.
Right?
No,
Yeah. I figure everybody's got jokes when it's when it's time to look at me flub my way through these things.
I
right?
might do the ending so well they may want me to do it again. So
Okay.
I don't want to
Yeah.
put it's like when the starting running back goes out, the backup running back comes in, performs well.
Okay.
How do you leave that running? How do you take the backup running back out again? So
Now, no pressure.
Okay.
But now you have to get it right in one take.
I'm
If
not
he
gonna get it
doesn't,
right.
please keep it in.
It's only going trust me. It's only going to take one take.
All right.
We're only going to show one take. So
No.
here you go.
All
Please
right.
keep it in if he doesn't do it in one
back
take.
to you, Troy.
They call me One Take Troy for a reason.
No, we don't.
And I'm guaranteed to mess it up now. Hey, thanks everyone for your time and attention. This has been Future Focus, a financial strategies podcast. I'm Troy Branch. Be sure to smash the like button, as my colleague likes to say. And if you get the opportunity, drop a couple questions in the comment below this video. Thank you so much. Have a great day.
Dang, you got it.
That was one take.
Boom.